So welcome everyone to the fourth and last session of the My Money and Me webinar series. Thank you for joining us today. My name is Wanda Roberts, and I'm an Extension Educator with Michigan State University Extension, and I work with a home ownership and financial education team. And I'm also, at least until December, the co-chair of the Financial Security for All Community of Practice with E-Extension. And this series this session will be focusing on putting yourself in a good space now so you have a brighter financial future. And as many of you already have done, you've added your name, email, city, and state into the chat pod. And of course, if you want continuing education or certificate for AFCPE, please note that. As always, I will do my best to monitor the chat pod and will answer questions as we go along as appropriate, or also pick them up at the end. And with us today, again, is Mark Robinson, who is a Certified Investment Fiduciary Analyst and also an Accredited Investment Fiduciary Analyst. He works with Michigan's Department of Financial and Insurance Services Investor Education in Your Community program. So we've partnered together to provide this My Money and Me webinar series for you. So without further ado, here's Mark.
And thank you all for signing in for part 4 of the My Money and Me series. Again, I'm Mark Robinson. We have an awful lot to cover today. And so Wanda, let's get to the first slide. Wanda has had shoulder surgery, and things are a little slow today. We'll get started here. I believe, Wanda, the first one is would like you to just give us your notion or summation of what you think risk is. What does risk mean to you? What is a safe investment? How would you define that in just a couple of words?
Some good definitions.
All right, we're seeing some good definitions here. Safe is protected from risk, an investment that I will not lose money on, an investment that gives you what you want at a loss level you can accept. Oh, well-diversified portfolio with solid investment choices. That's interesting. Very interesting. Great question. Is anything entirely safe anymore? You're right. That probably is true. And although there are less risky investments, there is no true safe investment. That's kind of a summary of this. So let's look at what is a safe investment. Can it be one that won't lose you money? That could be a definition of risk. Now, I pose this question today not for something for you to agree or disagree with, but rather just something for you to think about. So we could define safe as an investment that can't lose money or protects the principal. But then what do we mean by principal? Do we mean adjusted for inflation or just the nominal value? And do we mean low volatility, something that makes it feel safer because we are not having the swings, ups and downs? Lower risk could mean of not realizing a loss. Because in our industry, the financial services industry, we use often volatility and risk as meaning the same thing. But as you know, they're not. Volatility is just the ups and downs of the magnitude of change. And risk usually is the probability of you sustaining or realizing a loss. So there we have low volatility there. And we have something that increases the probability of meeting our objectives. Now that gets interesting because we can look at a safe investment, for example, an FDIC insured CD, and you say, well, okay, that's backed by the FDIC, and I understand there's risks there also, but more often than not, particularly now, my investment should be at least safe from loss. So that would be a safe investment. But if we define risk by increasing the probability or something that decreases the probability of me meeting an investment objective, and supposing that my investment objective is to grow my money over the long term to keep up with inflation, what would be more risky? A good, well-diversified growth mutual fund or the FDIC insured CD? Well, in that context, it would be the FDIC insured CD, because that does not increase the probability of me meeting my investment objective of growth over the long term to keep my money at least at a pace with inflation. So here's where volatility means risk. When we take an investment, in this context stocks, which is a very good investment over the long term, and I try to force it, that volatility, to work for me over the short term, and I use it to meet a 2-year obligation. I need money in 2 years. This is when volatility means risk. I mismatched the investment to my investment or my goal time frame, and I had to sell it. That's when volatility means risk. Here's when volatility only means volatility. When I buy a good investment in stocks and I allow it to grow over a multiple year or a multiple decade period, and I sell it at some point for a gain, and all of that short-term volatility to the downside works to my favor over the long term, because the very volatility that took my portfolio down or my investment down over the short term is the very volatility that has us at new highs with the stock market right now. Let's look at risk again. Is risk really about volatility? You probably have all seen a chart like this that says, in effect, the riskiness is over the short term here. And we get wide swings in this instance with the stock market being up big or down big. And as we get into longer holding periods, we see that we more approximate the average return of stocks, which is about 9.8%. And when we get out over to the 20-year, 25-year holding periods, we see that there are no down years. So that's one way to look at risk. It's all about volatility, especially in the short term. But let's take that chart and just flip it horizontally. Or is it, in more human terms, a shortfall in money? For example, I invest $10,000, and either based on me getting competitive rates of return or not getting competitive rates of return, not controlling the cost or my asset allocation, there's a 2 percentage point difference here. And you can see, when summed up over a 25-year period, the difference in the annual return and the terminal amount of money. And the big question here is not, wow, what's that percentage difference? Is, from a human standpoint, is that life-altering? So my suggestion is that risk really is more about a shortfall in money, and what we should be striving to do is decide what you want to be afraid of, short-term volatility or having a shortfall in money. We ended last week with the sequence for investing decisions, and what this really is a distillation of a process that we would use were we running a pension plan or an endowment. We would want to know, what is it we're trying to accomplish? In other words, what are our goals? How much time do I have to reach each goal? In other words, the time frame. Is it short term, 3 years, 5 years, which would be intermediate term, over 10 years, which would be long term? And then from there, determine how much risk should I take or might I want to avoid in reaching each of those goals? And then comes the decision, all right, a short-term goal, how do I allocate to that? A longer-term goal, what can I bring into the portfolio that increases the probability of me meeting that long-term goal? How would I allocate between the broad asset classes of stocks, bonds, and cash? And then the last critical step, unfortunately, where we typically start, is with, what should I buy? And when you go through this process, though the individual security is an important consideration, it might not be the most important. And really the first four in aggregate allow you to get to the fifth point here, what specific investments, and assuming a broadly diversified portfolio, and if you're working with index funds, it's pretty much a plug-in. Goals by time frame. You might have something like this. We typically all have multiple time frame goals, and of course would have to allocate to them differently. Where we would put money to meet a 2-month obligation might be very different from where we would put monies to meet a long-term obligation, like buying that bag of groceries out 20 or 30 years from now. Here's the chart again showing the volatility of the stock market historically over holding periods, 1 year out to 20-year holding periods. So the purpose of this chart is that a very good investment like stocks over the long term, if what I'm trying to do is use the stock market to meet a shorter term liability, just looking at that chart, if I needed my money in a 1 year or a 2 year period, I would not put it into the stock market. Now, for a 10-year, I would do that, certainly a 20-year, and I might take the bet on a 5-year. 86% of the time, rolling 5-year or holding periods of 5 years are positive. So these are general guidelines on matching short-term investments to short-term time horizons and longer-term investments to longer-term time horizons. So typically, in the most general sense, under 2 years, when you absolutely necessarily must have your money available, it should be in cash or savings or CDs or high-quality bonds that come due at or before when you need the money. I'm sorry rates are so low, but that is the general guideline. Now, when we get over to maybe 3 years out to 10 years, here's where you can strike a bargain with the risk of the market. To pursue higher rates of return, you may want to bring in some stocks, assuming a broadly diversified portfolio, into your portfolio. For example, if you are paying for college tuition, and let's say it's 5 to 6 years from now, you might say, look, college tuition can go up, a lot can happen in 5 or 6 years. I'm willing to pursue higher rates of return and the risks associated with that. I'm willing to put some monies into the stock market, and then it comes down to whether you want to put in 10, 20, 30, 40, 50%, and as we get out closer to 10 years, depending on your risk tolerance again, you might leaven the portfolio with even more what we would call riskier, growthier assets, and we're just using stocks as a surrogate for that. So all I want you to get from this is not so much percentages or getting down to these time frames, is just to get the intuition of when it is short-term money and you absolutely necessarily need to have the money available, match that up with investments that have a very low probability of losing you the money that you'll be needing soon. And for longer-term objectives, for example, growth over the long term to keep up with inflation, matching that up with investments that will grow the money you'll be needing later. Some of you may be familiar with this. This is called a glide path, and this is used often to illustrate how target date funds work. And target date funds are those funds that you may have with your employer, or you can buy them through mutual fund companies that have a date next to them. It could be 2050, it could be 2016, and the longer or farther out the date is, the more growthier investments they have in them, so that they can take advantage of the growth and the volatility to work in your favor when measured over the long term, and put more diversified stocks or other growth assets into it. And as we get closer to a terminal point here, let's say it's 5 years to 2 years or 1 year, investments like diversified bonds and cash that have a lower probability of losing you the money you'll be needing soon. So that glide path just demonstrates very good investments over the long term, like stocks for growth, are more appropriate for very long multiple decade periods. They don't work over the short term, and vice versa. If you're looking for growth, then short-term investments like bonds and cash might not be giving you the rate of return that you need if what you're trying to do is keep your money up with inflation. All right, we have a quiz question coming up here. And Wanda is working the mouse with her left foot in her nose. This is absolutely remarkable. All right, so the question is, higher volatility investments like stocks, stock mutual funds, and exchange-traded funds, long-term bonds, high-yield bonds, and precious metals are more appropriate for, you tell me. All right, that's close enough to everybody answering in here, and of course, it's unanimous that it's for a long term. Now, this is interesting because in isolation and in this context, we all think, well, of course, either based on the slides or my own knowledge of this, it makes perfect sense. Unfortunately, when we get into a context of the markets, like, for example, back in 1998, 1999, 2000, we had a full 5-year period where the stock market was averaging at least 20% a year. And we can be lulled into assuming a lot more risk than what might be inherent in the market. And so it would be perfectly understandable and explainable why someone in 1999 would say, well, I need money in 2000. I've had 5 years experience with the markets being up at least 20% a year. And then you can see how we could get ourselves lulled into matching up a long-term investment to a short-term liability that we all knew about, we needed the money to do, and then what happened? Well, the markets were down 20-some-odd%. All right, so let's look at the sequence for making investment decisions and put your answer in the checkbox here. But which, just based on what we've learned so far, which is a better sequence? What specific investment should I buy? How much risk can I handle? And then how much time do I have? Or do we start with how much time do I have? How much risk can I handle? And then what investment should I buy? Which sequence is the better sequence? Well, the answer, BB. So that is true. That is the better sequence, and I was hoping that one of the CPAs or some other credentialed information would throw an A in there just to rattle us up here in Michigan. All right, you're right. All right, so let's look at asset allocation, risk, and time frame. Okay, please answer this one. Okay, you've got the answer right. It's actually the next slide, Wanda. So you have that one right. And again, it's just reinforcing the fact that higher volatility investments are better for longer term time frames if you're willing to assume the higher risk associated with that. So again, it's almost like when we used to go and buy clothing, the Garanimals at, I think it was Kmart, where you just match the elephants up with the elephants and the lions up with the lions, and you had a perfectly matched outfit like I'm wearing today based on that. And we just want to make sure that we are matching up the right types of investments given the risk tolerance and how much time we have. And then we answered this one, which was the C. Low volatility, low risk investments are for short time frames or when you absolutely necessarily cannot accept any tolerance for risk. This is one of my favorite quotes, 20th century, early 20th century English journalist. The real trouble with this world of ours is not that it's unreasonable or that it's reasonable. The trouble is that it's nearly reasonable, but not quite. This is where it gets good. Life is not an illogicality, yet it's a trap for logicians. It looks just a little more mathematical and regular than it is. Its wildness lies in wait. Well, so too with the markets. And sometimes we look at markets, and those of you who may be academics, we love to reduce them down often to Excel spreadsheets, thinking that often there is more predictability to the markets, and often they don't lend themselves to tidy graphs and charts, because really the markets are more of what we would refer to as a complex adaptive system and are constantly becoming what they're not. And so let's look at another question here, and this one is: in your 30s and 40s, what can you do to prepare for a secure retirement? And just give us your thoughts. Good answers. Start a 401k. Most of it is centering around savings, which is important. All right, so let's move on from that. And that savings is indeed important. And the importance of getting monies saved. Now let's look at this. Is average really average? I believe earlier I said that the stock market over this 87-year period has averaged right about 9.8%. So we've had 87 rolling one-year periods. And my question to you is, we talk about the predictability and the straight line calculations out of the market's rates of return. My question is, over this 87-year period, let's take that 9.8, and we've never had a 9.8 year, but how about from 3% to 17% average, or the annual rate of return? How many times do you think over this 87 one-year holding periods were we somewhere within 3% to 17% on an annual rate of return for the stock market? How many times? Just type it on in. Okay. Maybe you're seeing the answer, or maybe the pod didn't show up. But what is remarkable is that it's only been 25 times. So around 30% of the time, the stock market's annual rate of return has been either below 3% or above 17%. Looked at statistically, If someone were to ask you, and those of you in the financial services industry, what do you think the stock market's going to do next year? You could say with confidence, statistically, and using historical data, that it has around a 52% chance of either being up over 16% or down over 16%. Stocks don't deliver 9.8 average annual rates of return in sequence in isolation. They deliver returns in clumps. For example, back in the 60s, we had a market for 15 or 17 years that didn't even keep up with the rate of inflation, followed by, going into the 80s, a tremendous bull market where the stock market averaged, I believe, around 14 or 15%. And then we've had a period after that, going into the 2000s, where we've been, again, in the low single digits, helped only in the last 2 years by the market rates of return. So stocks return in clumps, and you don't know which one you're investing into, which period you're investing into. So my point on this is not so much to have some amazement with these statistics here and what stocks return, but more so to drive home the point that the longer holding period you have for equities, you increase the probability of equities giving you a rate of return that is real, meaning above the rate of inflation. So again, very good investment like stocks. The longer the holding period, the higher the probability of that working out to be an investment for you with some growth over and above the rate of inflation. Now, we talked about being average, and look at, for example here, look at the historical returns given by decade for large cap stocks. And for example, in the 90s, someone was enjoying a rate of return of 18% for that entire decade on stocks, followed by the next decade, going into 2000, with a negative rate of return. Look at the dispersion there between those two. Look at, for example, treasuries, long-term government bonds, number 4 on the list. What if you were one who did not want to take a lot of risk, and you were investing in the 1960s, you didn't even keep up with the rate of inflation. Yet in the 1980s, if you recall, interest rates were falling off dramatically. The return on the long-term government bond was over 12%, exceeding the rate of return on stocks when measured over an 80-year period, their average annual rate of return. In the 70s, unless you put all your money in the small cap stocks, you didn't even keep up with inflation. So my point in here, as G.K. Chesterton had pointed out, its wildness lies in wait. It can look a little more mathematical than it really is. There are no guarantees in life, and there are no guarantees in the markets. All right, let's move over to dealing it with on an aged basis approach. The only way to deal with the future is to put yourself in a space where you are dealing effectively now. We have a question coming up in here also. Doing that? We did that one earlier? Okay. So Wanda's mixing it up not only for you, but for me. All right, so we go with dealing with it in our 30s and 40s. The central theme in this is you can't save too much. That doesn't mean you live off of tap water and saltine crackers, but you need to maximize savings. So you can do that through your employer-sponsored retirement plan, IRAs, anywhere that you can save money based on what your goals and your objectives are. So again, allocate in accordance with what it is you're attempting to accomplish and the risk you're willing to assume to accomplish whatever that is. And it's important to begin to minimize debt accumulation. That's very difficult when we're in our 20s and 30s, because that's when we start accumulating homes. We start buying all of our stuff, so to speak. And so it's very difficult. So what we want to do is not reduce debt, but at least control the accumulation of debt. You can contribute to your employer-sponsored plan or contribute into an IRA. Now, here's some of the math on this. Now, again, these are general guidelines. So if you fall within or outside of these, that doesn't necessarily spell trouble, but just at least alerts you to maybe what this ought to start looking like. Maximize your savings. So let's say, for example, this couple has an annual gross income of $50,000, and their total savings with what they have, whether it's IRAs or their retirement accounts, is $75,000. The ratio here is 1.5. And they're right in there, right kind of in the sweet spot here of what they should have saved relative to their gross income. Because remember, when you retire, we're trying to replace some percentage of that gross income. So here's this based on an age-based approach. And again, matching up the right type of investment for the risk and the time frame that you have. Again, low risk, lower return would be cash. Moving out to where you want to assume the volatility, we would get into the small caps, large caps, lower quality, corporate bonds, and of course, foreign stocks. Again, just to bring a relationship to this. So, risk and time frame, higher percentage, perhaps of more volatile or risky investments. Those would include mutual funds that are composed mostly of stocks, or exchange-traded funds composed mostly of stocks. Long-term and high-yield bonds would fall into that category of more risky, more volatile, but again, more return potential. Commodities, precious metals, natural resources, other alternatives would also fit the bill on that. And these would be, again, more appropriate for longer-term time frames or for a higher risk tolerance, and would be age appropriate based on what we're having here. Now, we need to also minimize debt accumulation. Let's stay with the same couple here. $50,000 annual income. Their liabilities are $125,000. And this ratio is 2.5. Now again, let's not get hung up on that, but you can see by looking at the ages in here by decade, the thinking is to increase your savings, the multiple relative to your income, and decrease your liabilities relative to your annual gross income, so that when you retire, you don't have that debt overhang that can really take a bite out of the cash flow. All right, Wanda is pulling up a poll here. In your 50s, what can you do to prepare for a secure retirement? There's some very good answers in here. Some of the more obvious mathematical ones, be debt-free or have less debt, a higher ratio of savings to debt. I like this one, stay on a plan, keep on the plan. That's very important also. So you're getting the move in with children, and that's a very practical, very practical. Unfortunately, the trend's been the other way, but thank you for a little bit of levity in here. All right, so let's move from the 30s and 40s and dealing with it in our 50s. Again, the theme is maximize the savings. And if you're able to utilize catch-up provisions or manage your budgets in such a way that you're able to save more, that would be good. And then again, look at your investing time horizon, what your goals are, and then invest your assets in accordance with your intermediate term goals or your longer term goals, and again, minimize the debt accumulation. So you can contribute up to $23,000 as of 2013 in an employer-sponsored plan, $6,500 for your IRAs, and if you're working with a corporation and given certain guidelines, you could start at this point making withdrawals from your plan without a 10% penalty, and of course at 59.5 for any withdrawals from IRAs. All right, so here we are Our couple is in their 50s now. Their gross annual income is $75,000. Their total savings is $300,000. And they're kind of right in the sweet spot again on where they should be, their savings that they will use to supplement Social Security and other benefits that they have, their income. And so they're at 4 times what they should have, or 4 times their savings relative to their gross annual income. Again, these are general guidelines. So here's where they might be in terms of how they might want to invest based on that glide path that I had shown you earlier. They're in their 50s, probably going to retire within a decade or just a few years, depending on what their plans are. And so the thinking is on this in the most general terms would be to start reducing those investments that could have a profound negative effect on money they might be needing soon, and start to put more types of investments like bonds into the shorter or intermediate term bonds into this that decrease the likelihood of them having a major market value adjustment, as we might call it, within a few years of when they might need to have that money. Again, just general terms, just to kind of grasp the relationship here. So we want to balance, in this case, more volatile with less volatile, and that could be still stock mutual funds, shorter intermediate term bond funds. We could also use balanced funds that are a combination of stocks or other types of growthier investments with bonds to have this be more appropriate for an intermediate term time frame or a lower to moderate risk tolerance. So here's where we want to be on debt. We're making $75,000 a year. It seems as though they've been reducing their debt and not taking on more debt. And so their ratio is at 1.25. So they are moving away from higher debt into a lower debt scenario here with more savings. So this is how this should look. It's a concomitant thing. Saving more, increasing the net worth, while at the same time reducing the debt so we don't create the drag on the income. And I believe Wanda has another. So what does it mean to you to get organized in relation to your finances? Yes, it does include the mortgage. That's a good answer, George.
Dang, it's a gold star. It's interesting what folks think about being organized.
Very good answers in here. So let's get organized. Where is your money? And this might be an important time to start aggregating and looking at all of your investments, or if you're married, your spouse's investments with yours, and looking at it, aggregating it, and looking at it as a whole. Where is your money? And then how is it titled? And that can be just as important, knowing how your money is titled, whether it's a trust, individual accounts, joint with your wife, joint with another family member. Is that still appropriate? And just from a liability standpoint, that can be a very important consideration, is to look how you're titled in addition to just where your money is. How's my money invested? This is a good exercise to aggregate and look, not at your accounts individually, but in the aggregate. Because when you do that, often you can see that taken together, it looks a lot different than what you think it does. We have a tendency to look at, well, I've got my IRA, I've got my 401k, and we don't say, well, what really does this look like in aggregate, and is it in accordance with my goals and my objectives and the time horizons for meeting them? So you'd want to know the total value of your accounts also. So let's have some fun here just to get organized, and let's use $1 million just because it's a lot more fun than using $10,000. So this person or this couple has money all over town. And usually this takes years to get to where we're looking like this, but let's see if we can clean this up. And you'll see something else that happens as we do this. So let's start with mutual fund company A and mutual fund company B. In one, I have $100,000 just sitting in cash. And in the other, I have an S&P 500 index. But I also see that this individual has a discount brokerage firm. And with discount brokerage firms, for the most part, they have selling agreements with most mutual fund companies, and we have some individual stocks in there. Perhaps this couple likes to buy some individual stocks. So we have two other accounts here that we may be paying an annual administrative fee on, and it's two other statements that come to the house. So let's clean those up for them and drop those into the brokerage account. Now look what happens. I begin to regard it a little bit differently. In looking at that account that now has $300,000 in it, I see that I'm pretty much 2/3 in large cap stocks and 1/3 in money market. Now, does that mean anything to me yet? No, it might not, but at least I see how I'm allocated. Let's go up here and look at the brokerage account. One brokerage account is $100,000 in cash. And maybe that account has been there for years, and there just isn't good communication between the broker and this couple. And the other one is put together a nice bond portfolio for them. Let's pretend it's a laddered bond portfolio. He or she is calling them on a regular basis and giving them a lot of service. So let's do the right thing here and take the money from the one brokerage account and put it over with brokerage account A. So now when I start looking at the brokerage with the discount, I'm seeing something here. I have about 1/3 in fixed income, meaning bonds. I have 1/3 in cash, and I have 1/3 in large cap stocks. So with a very large portion of this overall portfolio, suddenly I'm getting some clarity as to how I am allocated. So let's look over at this little stranded piece of money over here, this traditional IRA with $50,000 in cash. You can see how someone could just forget about that because there were 7 accounts at one point. And let's look at the other traditional IRA, broadly diversified. And why don't we take that traditional IRA and put it up with the other IRA? And so now it forces you to look at that and say, well, do I really need to have $50,000 in cash there? And I have $100,000 in cash over at the brokerage firm and $100,000 in cash over at the discount brokerage firm. So you start looking at that and saying, is this in accordance with what it is I'm attempting to accomplish? So in cleaning up your accounts and aggregating them, we get an idea of whether we're really having all of our investments working to our better interest, or are they actually working against us? And then at some point we'd have to make a decision about the 401k, but we would certainly put it into our calculations here. So it's not your accounts that make you money. It's what's in them that does. And so you need to know what's going on inside your accounts in the aggregate. So here's that portfolio again. I put this together, and I still don't know really how it's aggregated, but let's look at our couple here. We're both 51 years old, and they plan on working to age 67. That's another 16 years. And they're willing to assume the risks and volatility of a portfolio made up mostly of stock. Now, by the look on their face, I think we've got some problems here. Because when I aggregate that portfolio that we already have organized and look at it, here's how it's allocated. So they have 55% of their portfolio in bonds and cash. They have a token investment in mid-cap, small-cap, and in foreign stocks, and the rest is in large-cap stocks. So this is problematic for them. They said they wanted to take the risks of the market. Now, over a 3-year average period, here's the deal. Their portfolio is on the right. It's averaged about 8% for a couple that was willing to assume the risks of the stock market. So if they had been 75% in stocks and 20% in bonds and 5% of cash, look at the spread between what they were earning and what they are earning or could have earned on the portfolio. So on a $1 million portfolio, what was falling through the cracks on them over this 3-year period? A substantial amount of money. So more often than not, in my industry, looking at portfolios, where we see typically the most slippage is not people having lousy investments, but they have lousy oversight and management of the management of their portfolio. Here's a perfect yet exaggerated example of that. All right, dealing with it into your 60s to 66 prior to retirement. Again, continue to make contributions. Identify your shorter-term liquidity needs. And as we've learned, that might mean moving some monies out of either longer-term or intermediate-term type investments and over into shorter-term type investments where we might need to have that money available and not lose it. Confirm your Social Security benefits and other sources of guaranteed income and continue working down the overall debt. So here's where we are now. Our couple is now making $82,000 a year. Their investments are at $650,000. They're looking pretty good here on the ratio. And we need to look at their short-term liquidity needs. If they have them, then they want to move their investments more into those types of investments that decrease the probability of them losing the money they'll be needing soon, and those would fall into the Treasury bills, savings accounts, CDs, money market, stable value accounts, arguably, and these would be more appropriate for a short time frame and for no risk tolerance. So when we look at this again, if I need money over the short term, I would not want to have it in equities, and again, over the long term, that might make some sense based on the chart here. Again, matching up short-term investments with short-term goals and longer-term investments with long-term goals. Also within this time frame of 60 to 66, you can begin to take your claims on Social Security benefits. The conventional thinking is that unless there are issues in your life to where you need to take that, there are tremendous incentives for holding off as long as you can on taking Social Security. Make sure you sign up for Medicare Part A and Part B so you can avoid the 10% premium increase for enrolling later. Those between 1943 and 54, you can receive full Social Security benefits at 66. And then it moves up, as you can see through here, and I'm not going to belabor this, but it is kind of based on when you were born. And then for those of us born 1960 or later, we receive our full benefits at 67. Reduce the debt. So we can see that our couple here has done a good job in reducing their debt down to about a fifth of what it was when we started. And again, don't get too hung up on the bands here, but that they are reducing their debt. And now we have it down at a very handsome 0.35 ratio relative to their income. After 66, minimize overall debt, minimize taking on new debt, because again, that creates a tremendous drag on the cash flow because you do not have typically human capital anymore. In other words, your ability to go out and earn income. So we want to manage your spending, because what you do have saved are the other sources of income that are coming in. We want to make sure that there is enough to sustain you during your lifetime. It's important also that you know the rate of return on your retirement assets and know how much your withdrawal rate is. Because what you don't want to be doing is taking more out than maybe you are earning, and you're literally pulling the bark off the tree. So you need to know the rate of return. You need to know what you own from an investment standpoint, why you own it, is it in accordance with what you are attempting to accomplish, know how those investments are doing, meaning a rate of return, and you need to be informed and aware of your accounts. So in this mock-up here, our couple going into retirement, $82,000 a year. They've paid everything off. So all of that earned income flows right through, doesn't have to go to debt service, and they can use that for income. And here's where their savings is. And again, these are really high numbers in here. And you might think, I'll never save that amount. But again, these are general guidelines. And so how we'll look at these is that how we arrived at this, well, they have 10 times their salary would be the $820,000. So as you can see, based on different withdrawal rates, coupled with a calculation of their Social Security, we can replace around 70 to 80% of their income at the point of their retirement. And at 12 times savings, which would be pushing almost $1 million, again, assuming a 4% or a 5%, we can replace between 80 and 90% of their earned income. Now, this is just the math on it, and because we have math on this doesn't make it any more reliable or accurate, but it does show you how these multiples of your earned income come into play on this and the importance of them in providing you the income you'll be needing during retirement. So we need to manage our overall spending. Which of these four types of expenses gets us into trouble? Well, they all do, because our discretionary often moves up into fixed. We're just fixed on having those discretionary expenses, and again, that creates drag on our earned income as we go into retirement. Now, we had talked about you need to know what you own, why you own it, how you're doing, and compared to what. Now, if you're not doing that, it goes beyond you just saying, well, you know what, maybe I don't have good investments, or I'm just a little sloppy about it. It's bigger than that. It means you do not have control. And it's very important for you to have control, and Wanda's got control over the mouse right now, and so I'm being pulled into a poll question. How do you measure performance of your investments? All right, these are some good answers. Leave those up there for a moment, Wanda. Diane writes, tend not to monitor them too closely, except on annual statements. That's a very interesting comment there, because often, though we often will measure performance monthly, some people quarterly, I'm not so sure that what is showing up there is performance as it is we're just seeing variability or volatility showing up. George writes, it must beat inflation. Well, that might be the ultimate bogey, is to keep the dollars real. Measuring against benchmarks. I like that there's an S on there rather than a benchmark. And it could be based on what your goals are. And so it could be a minimum acceptable rate of return. It could be inflation plus. And if we're measuring it against a benchmark, it better be a relevant benchmark to what the composition of your portfolio is. So all of these are ways whereby we can say we know what we own, how it's doing, and compared to what. So let's look at this very simple. Know what you own, why you own it, how you did, and compared to what. Well, let's look at the first two. Know what you own. All right, well, I went to the library at Michigan State, and I did my homework on some mutual funds. And I thought, you know, I've got a longer-term time frame. I'm going to put it all in the stock market. And so I did research on 4 really good mutual funds. And these are really good managers, and they know how to pick all the good stocks, the ones that go up, and avoid all the ones that go down. And so I gave it over to these 4 mutual fund managers in that allocation. So I know what I own, and I know why I own it based on my goals and my risk tolerance. Now, how did I do? Well, I was able from the same sources to find my ending period returns for those mutual funds. So my large cap was up 10%, all the way to my small cap being up 14%. But that doesn't tell me a lot either. I need to do the math on what should have been the return on a portfolio that is composed 60% of large company stocks that also took the risk of mid-cap, small-cap, and foreign in these weightings. So that portfolio returned 10.6%. Now, is that enough information? Well, not yet, because I haven't compared it to something. Now, just from a consumer standpoint, me as a consumer, here's these 4 mutual funds. I'm paying them. And I have to look at that no differently than I'm paying somebody else for a service. Did they render good service, provide good service to me? Because I can go and buy performance or buy returns at 1/10 of that cost through index funds. So I would look at their performance relative to a benchmark. So I would want to know, how would a portfolio, a representative portfolio composed of those cheap benchmarks that I can buy, typically a benchmark is an index, for 1/10 of the cost, how would that have done? Well, I can use the same math to arrive at that. And this tells me that the benchmark did 11.7%. My portfolio did 10.6. Keep in mind that's net of fees, which when we use mutual funds, they are reported net of fees. So this tells me a lot in here. It gives me the what happened. So I can look at it just bottom line, I underperformed by 1%, or I can go back and saying who didn't pull their weight. And I can see that I had some slippage with most of the funds outside of my large cap fund, which matched the index. And so it gives me a point whereby I can go back and look at what happened with my mid cap, my small cap, and my foreign. Is it just they zigged and the market zagged? Is there a new manager? Do they have have they drifted away from their investment objective? All of those things allow me to get more control over my account. And if you're a do-it-yourselfer, you have to do that. Or if you're working with a financial services provider, they know how to do this for you, because that's the standard of care here, is in measuring it as a blended benchmark, because it alerts us to what is working and what is not working. So what is a safe withdrawal rate? Frankly, we don't know. I remember back in the 90s, we thought it was 8, 9, or 10%. Then the market started to move downward. Then maybe it was 8, 7, 6%. Then it was 5%. Then it was 4%. Now, just based on that, you know that we don't know what really a safe withdrawal rate is, because there's so many factors that come into play on what is actually a safe withdrawal rate. Now, the IRS has one way of doing this. And they can spend down your money for you, and they do it kind of based on, well, if you're not going to leave any money, here's how the withdrawals would work out of your portfolio given certain ages, going from 4% withdrawals, or roughly 5%, all the way to taking out 18 or 19% out of your income. And how this works also is it adjusts it based on the value, which might make some sense here. In good years, you're taking out a little more based on the percentage, and in years where the markets are not doing well, you adjust your withdrawal, recognizing that you don't want to sell things that may be down, and so you adjust the amount of withdrawal in here. So one way to go about it is, if you're not going to leave money, just use the IRS tables. All right, let's go to the next. Do we have a poll here or a slide? Nope. Okay, just be informed and aware is the next one. Know your investment objective. Every account that you will ever open with a brokerage firm, whether it's online, you're a do-it-yourselfer, or you are working with a financial services provider with a national or regional firm, you will be asked what the investment objective is so that he or she can populate your portfolio with appropriate investments, or if it's a broker that you're working with, they can recommend suitable investments for you. So you need to know what your investment objective or investment objectives are, and then confirm that the holdings are consistent with your investment objectives. And you just don't need investments in there for the sake of diversification or more of the same stuff. You need to look at it from a holdings basis standpoint. How does each investment contribute to either its own little goal, or if you've dedicated it to a particular goal, how does it contribute to the whole here? Know your investment strategy or your tactic. So we have our investment objective, which is a what, conservative growth and income, and then the strategy is the how. How am I going to go about affecting a long-term growth investment objective? Am I going to do it with just a buy and hold strategy, maybe using indexes and do like a lazy portfolio? Or do I think that that doesn't work as much as it maybe did a few decades ago, and that because of this inextricable link we have between the markets globally and political and geopolitical, all we have to do is look at the recent wranglings in Washington, that maybe a more active or adaptive strategy might make some sense? If so, what are the triggers that have us do one thing rather than another thing? So these are just knowing your strategy and your tactics, the equities in your portfolio, what do you own and why? Same thing with the fixed income. What do you own and why? Measuring your performance. Don't ever settle for, and unfortunately, it's sometimes used quite a bit, where you have a portfolio composed of large cap stocks, you've got some real estate and some small cap and emerging markets, let's say, and a short-term bond fund, and you get your statement, and they say, yeah, well, we'll give you some performance on it. Your portfolio was up 8%, and then they give you a listing of benchmarks. And I guess leave it for you to figure out. So if you're working with someone, and most financial services providers, upon request, or they will do it as a matter of course, will give you a blended benchmark to show here's a benchmark that truly represents how your money is invested. Is your rate of return relative then to a benchmark? Or as we saw with some other write-ins here, no, I want a minimum acceptable rate of return. And maybe it's during the accumulation phase while I'm still saving, it could be 5, 6, 7%. And in my distribution, I need to have that because I'm taking out 4%, and I want a good 2% spread on that. The other important thing to do is to know what you're paying for in fees and commissions. And when you are working with a broker, you'd want to know what the commissions are. Now, a commission broker would tell you, and will tell you, well, all right, we've charged you $2,000 in commissions this year. All right, well, what does that represent of the monies that I have with you? Well, it represents around 1.5% of your total holdings in commissions. Fair enough. That would be viewed by regulators and most in the industry as very fair, competitive compensation on a commission basis to have it somewhere under 2%. If you're working with a fee-based advisor, you'd want to know, am I paying an hourly rate? Is it by the job? Or is it based on my investable assets? You'd want to know what's covered. Are there other investments that aren't covered with that fee, that have been excluded? For example, a lot of advisors, if they have a proprietary limited partnership or a private equity deal in there, well, they're already making fees off of that. Why would they charge an additional advisory fee just to camp on top of a product that kind of unwinds itself over a multiple year period? That would not be, in my opinion, acting in the best interest of their clients. And so sometimes investments like that are excluded from the management fee because of their structure. They usurp the prerogative of you or the advisor to really do anything. So you'd want to know what those are. If you are in a wrap account, very popular, where the advisor is picking mutual funds for you and says, don't bother with it, we'll do it. And we'll report on how those funds are doing for you. And for that, we're going to charge a fee on top of that. So you'll have two sets of fees, one to the mutual fund companies and one to the advisor. You would want to know in aggregate what those fees are. So, for example, if the mutual funds, the average expense ratio was 0.5%, and the investment advisor was charging another 1% or 1.25%, that would be a very acceptable 1.5 to 1.75 total fee. But you need to know that because there's two layers of fees in there. Okay, that ends this afternoon's presentation, or for some of you, this morning's presentation. And if you have any questions, please type them in, and we'll take a couple of minutes to answer those for you. And I'm going to turn this over to Wanda. Thank you all.
Well, thank you, everyone, for attending the My Money and Me series. I noticed that there's many of you that have been with us through all 4 sessions. Trying to get the post-evaluation chat pod up here. Try another tactic. If you would take a moment, and in the chat pod, there is a link to a SurveyMonkey survey. If you would take a few moments to take that survey, we'd greatly appreciate it. But as Mark said, we'll give it another couple minutes. If people have any specific questions, we'd be happy to try to answer them. I see a few people are typing. Well, thank you, George, for attending the series. And I know we had a question about particularly the slides from today's presentation, and particularly focusing on the suggestions of what folks should be doing kind of age by age. And like I said, Mark and I will put something together that we can share, and we can email that out to folks when we email the certificates. Well, seeing that we're not having any questions at the moment, again, just a reminder, if you would click on that SurveyMonkey link to do our post-survey assessment, we would greatly appreciate it. And, oh, Andrea has a question. I'm speaking too soon. Mark, we have a question about how should folks think about or factor in military retirement that they might start collecting in their 40s when they're planning financial savings or investments. Any particular thoughts about?
No, I'm not familiar enough with the particulars of military retirement, but and I don't know enough about military retirement to comment on.
Okay. Yeah, neither of us, thanks for the question, Andrea, really are familiar with the military retirement system or how it works. But just looking at that, assuming, you know, they have a military retirement piece, it just, of course, needs to be figured in as best it can with that magic number that, you know, we think we'll need ultimately in full and complete retirement. Which is possible, as Andrea pointed out, that maybe their income goal could be reduced. But again, it really, of course, depends on each individual and what kind of lifestyle they want to have when they're, 60s, 70s, and maybe full-on retirement. And where the sessions are recorded, the links are provided actually in the e-extension Learn system, and I can email that link or those links to those pages out also when I email out the certificate and a few of the slides that we'll share. So thank you everyone again for your participation, and hopefully we'll be able to provide future webinars, and we'll let you know when those come up. Thanks everyone, and have a good day.